All right. Welcome, everyone. We will just wait a few minutes to get started here. Wait to go live on all the different platforms, but thank you for tuning in. We'll put the chat up here. You want to drop a comment there in the chat, feel free to do so while we wait here. Hello, Oscar. Hello, Pearl. Hello, everybody. Hope everyone had a great holiday weekend and then got some work done today. A little chaotic, back to it. But we got some good stuff to go over here tonight. Shout out to everyone on the team tuning in. We appreciate everybody being nice and early on here. And we'll wait just a couple minutes here to get live on all the platforms. Hello, hello in the chat and the comments. Okay. Looks like we are about live on everything here. Thank you, everybody, for tuning in. We can go ahead and get started here, Nick, I think. Looks like we are live. All right. So, thank you, everyone, for tuning in. My name is Kyle Hershey. I am the COO of the Mortgage Calculator. I am joined here by our president, Nicholas Hershey, and our sales manager, Jose Gonzalez. And today we are going to go over a great topic here, which is how to structure portfolio loans. So, being that we are mainly a non-QM lender, and this is what we specialize in, portfolio loans are definitely something that we do, right? So definitely something that we're familiar with, and definitely in our wheelhouse here at the Mortgage Calculator. So today, for everybody watching and for our loan officers, we're going to talk about what a portfolio loan is, when would we use that portfolio loan as one of our tools, and how can we use it to our advantage, and we'll actually look at a portfolio loan quote as well. So I know Jose is making a portfolio loan quote right now, but I'll do is I'll have Nick talk a little bit about what a portfolio loan actually is. What do we mean when we say portfolio loan?
So really a portfolio loan is a cross collateral loan. It means there's two, different deeds, two different properties on the same loan or more, right? So these are very difficult loans to do because it entails a simultaneous closing of not only two, but typically 3 to 10 to we've probably done up to about 40 properties in one tranche. Typically, if you get to 100 properties or so, you'll break them up into separate tranches of approximately 10 is usually the most manageable amount. And it's very difficult to do because you have to use the same title company. Obviously, you have to do a simultaneous closing on all of them, and they do all have to have separate title and close separately, but close on the same day with the same mortgage and note. So it's a little bit different. A lot of investors are used to it, and it's kind of a more traditional way to finance rental properties when we only had really commercial options and local banks that would do these things for local investors. So this is kind of an old way, I would say, of doing things, kind of a more traditional model. The DSCR has largely replaced the need for this, and actually, typically, we find that I'd say probably about 90% of the portfolio loans we deal with are taking people out of portfolio loans because they are kind of antiquated. They're usually a balloon feature, so they usually have a 20-year AM or 30-year AM. but a balloon, right? So the note's due before the end of the term. So there's usually a balloon of some kind with a traditional type of like a local bank portfolio commercial product. So thankfully, we have some more traditional 30-year fixed kind of DSCR based options that do allow us to do cross collateral. But the old, antiquated commercial banking model of portfolio loans is definitely one that we want to try to usually avoid. So the portfolios that we focus on here at the Mortgage Calculator are going to be the newer style, which would typically be a 30-year fixed, more of a DSCR based type of traditional product, and we'll typically take our customers out of the old commercial balloon, less than 30-year AM or any other type of more risky features, and put them into either the more standard balloons the more standard portfolios that we have without the balloons, or we'll actually try to take 10, 20, 30, 100 properties out of a portfolio and refinance them into a regular individual DSCR. And one of the biggest reasons for that is the carve off policies. So typically, when we have a portfolio loan, especially a traditional portfolio loan, they're going to either have a restriction or not allow at all for a investor, borrower, the client, to take one property out. So investors can not only not refinance a property, but they can't even sell a property. Like legally can't sell a property. So that really puts the handcuffs on to investors that really know what they're doing. And especially in this day and age when properties or values are fluctuating by the day, people want to strike quick and wheel and deal. And if you're in a portfolio loan, you might have 100 properties locked up. But the only way you can ever do anything with those 100 properties is sell all 100 properties at the same time to the same person at the same place with the same contract, because you've locked yourself into a loan that is tied into 100 properties. So unless you have $5 million cash laying around to pay off a $5 million note across 100 properties, you're going to be stuck with selling all of those at the same time. Most investors are, they have equity, but not 100% equity, right? You're not going to be able to just cash out a large portfolio. So we really want to be careful when we're talking about portfolios. We want to make sure we understand what our borrowers are in. If they're in one of those restricted portfolios, we're going to offer a solution, which is typically going to be a regular DSCR loan to take each property out individually and hopefully exit them from that portfolio, which is, like I said, kind of the reverse strategy. But if someone comes to us with a purchase agreement that has 5 properties on it, the only way to finance a purchase agreement with 5 properties, 5 portfolios, right? 5 tax IDs, 5 pieces of property on one purchase agreement is with a portfolio loan. There's no such thing as 5 conventional loans across one contract that has 5 properties, or 5 tax lots, or any way of that. So also, you realtors out there, make sure when you're structuring these deals, a lot of people will make the mistake of, for example, you have a property with a lot next to it, right? There's two actual tax lots. When you do a purchase, make sure you're only putting the purchase agreement on the house, the real property with the house, so that we can finance the house. Put another contract on the empty lot and make that contingent on the house selling, right? If you want to include them both for the same price. If you put both those IDs on the same purchase contract, we can't execute that purchase contract as a mortgage company, right? So this goes for some advice for the realtors out there, but also loan officers, most of our team out here. When you receive that contract, if there's any funniness on there, you got to know to try to undo that. And then also, if there's 10, 20 properties, you got to have the tool for the job, which is going to be the portfolio loan. So that's really kind of the things that I would want to make sure we watch out for and look for. So I kind of define what it was. Basically, it's anything over 2 properties. But Jose, you want to go kind of into detail of like some specifics, like I guess give more of those specific examples, and I think you have a quote as well. Once you're
Absolutely.
ready, let me
Well,
know.
Nick, I wanted to ask you, because you touched on it real quick. You did say they'd have to either refi all the properties or sell all the properties, but you mentioned the words carve out. Can you explain more of what the actual carve out is?
So most of those, the traditional model of portfolios will not allow you to sell one property of the whole. You have to pay the whole note and the whole note, and that's it, right? So if you have a $5 million portfolio loan, the only way to get out of there is to write the bank a check for $5 million. You can't sell any properties. You can't refinance any properties. You can't do anything with any of those properties that are in that portfolio until you cut a check for $5 million to the bank and they release all those properties. Then you can refi, sell, do whatever you want, right? So a carve off is where some of these loans, and the ones that Jose is going to recommend, typically are going to, if we're going to stick someone in a portfolio, we want to be very careful and let them know if there is no carve off. That's a very risky feature. But most of the ones that we like to offer are going to have a carve off policy where the investor could sell one property. There's going to be a penalty, right? There's going to be some sort of fee, but at least you can sell a property out of that portfolio or refinance it if that's the case, and get it out. There will be a penalty of some kind. Typically, they're not just going to do it for nothing. They're going to want to make sure that they typically pay more than what that property is assigned. So say that property is $100,000 of the $5 million loan, they're going to say, okay, you can do that, but you got to pay us $120,000 just to make sure that the rest of the properties are all fixed, right? They're not going to be upside down on the remaining bundle, right? So you're going to have some sort of penalty or fee. So Jose will probably talk about that on this because that's always the one thing that's like the icing on the cake is we got to figure out what at the end of the day is the exit, right? We want to make sure, especially in these portfolios, as I mentioned, they're a real conundrum once you get in there and you don't understand it. And then we have people coming to us just begging to get out of it, and it's very difficult. So we want to make sure before we get someone into it, they understand it, we understand it, and that they know how they're going to get out. Whether it's one property getting out or they think they're going to sell the whole bunch, great. Maybe we can get them into something that doesn't need a carve off. But we got to know the out before we get them in, right? So that's a good point there, Kyle. I might have skipped over that a little bit.
Yeah. And so I know Jose has a quote and stuff like that, but Nick really explained a lot of why we either wouldn't put them in one or why we would be getting them out of one, which he mentioned that we're doing most of the time. Jose, can you talk about why we would go into one? How can we, what kind of
Well,
situations would that come up in?
well, sure. Let me just first add a little bit more detail there about the issues here. Is you got to remember, we as the licensees, right? We have access to the data. We're supposed to have the knowledge, and our clients are counting on us to give them a proper consultation. So, and that's where we have to be aware of what the misconceptions are generally about portfolio loans, which is why then we have to consider what would be proper. Is it good to go into one, like you just asked me to explain? But first, we got to address the misconceptions. Why do most borrowers want to get, when they want to get a portfolio loan, what are they thinking is the benefit? They're usually thinking that it's going to be somehow cheaper, right? That they're going to save all this money on transaction expenses because they're going to do one loan for everything, right? So they're thinking it's going to be so much cheaper, like they're like it's going to be like almost free, that is going to make up for the fact of the different restrictions that Nick was mentioning, just being able to get out of the loan individually, the individual property. So again, first thing I guess we should lay down, as I like to do with any borrowers I'm dealing with, lay down some info for them to empower them on what a portfolio loan really is and on the different portfolio options that we may have. Because one of the quotes I'm going to show today is from one of our outlets, but we have more than one that is available for portfolios, right? So look at it and can properly convey to the customer if there's a carve out, if there's not. Because again, if they're trying down the road, all of a sudden they want to sell their properties and they realize, hey, nobody told me that I couldn't sell this one property. I'm getting like the offer of a lifetime. So sorry at that point, but so we have to make that really clear. So when would we be going into a portfolio? So Nick mentioned some of the obstacles that we would face if we have a portfolio loan on our portfolio, right? So a little bit of a redundancy there, because it's actually a blanket loan on our portfolio. Right. So when would we be getting into one? Well, there's a really good couple of good reasons why we would do a portfolio loan, and it would be typically you have multiple low value properties that typically would not be able to be financed on their own. And an example I can recall the last portfolio loan that I did. The borrower called me asking about how low can we go in the loan amount? So I said, well, it really varies. Typically for the standard DSCR loan, we can go as low as 75,000, but there exists, I think, one option out there, one or two options that takes you into the low $60,000 range. But um, that's few and far between to really be able to do that. So I asked him, what is it that you're trying to do here? What is the objective? Because I always like to find out. They come in with preconceived notion. Then after they say everything, I say, okay, what's your objective? What are you trying to accomplish here? And then we put on our consultant hat and try to figure out an action plan. So the next question I asked him was, okay, you want to buy property. That's pretty obvious. Okay, how much do you want to buy? Cheap properties. I didn't say cheap property to him, but obviously he wants to get low valued properties with a high DSCR. That's what he wants. He wants these particular properties were like 80, 90,000 rented for like 1,800, 2,000, really high DSCRs there. Like, I think the portfolio had a DSCR of 2.2. Amazing. That's why he wants to do it. Now we have to figure out a viable way to make it happen, right? And so I said, okay, you just told me you got $350,000, right? And you want to buy a property that's going to be, getting you a good cash flow. Amazing. So why don't you go and get at least six? Because this was for one particular portfolio option that required at least six properties, or no, actually, no, it required at least $300,000. So I told them, why don't you get at least six that are at least $70,000 per property? It'll be at least $50,000 per loan, and then we'll have at least a $300,000 loan for that particular option. Those were the minimums, and I can get you X deal. He's like, really? You can do that? I'm like, yeah. Man, this guy within like 5 days had me 7 contracts. He got them. He found the realtor, found the properties that were sitting out there in the market for months because, nobody had the 80 grand to buy it, and nobody could get financing for an $80,000 DSCR purchase. It was like catch 22, 2.2 over 2.0 DSCR each of these properties, and they're sitting there because somebody was not able to connect the dots for our investor. They kept trying to do the obvious. Let me try to find you the one cheap source out there. No, man. Let's group them and let's do it in a package deal so that you can get them as you need them, And he got his 7 properties. We were able to close. He got a very good rate. We did 75%, I think, on that one. So, I mean, everything worked out sweet. And for the seller as well, mind you, for the realtor as well, she got 7 deals in one shot. I mean, from a guy who she thought maybe was going to be a time waster for her because he was making her find the needle in the haystack until we found the catalyst. The catalyst was the portfolio loan that made that reaction possible. If we want to put it in a chemical type, talking chemistry here, right? We got a reaction, and the deal was a closing, right? And that's really how the perfect example, and probably one of the few examples where we would really be doing this, unless it was the guy buying the portfolio from somebody. He says, I'm only going to sell you my whole package, and that's how they want to do it. Another great portfolio scenario, but they usually don't work out that way. It's usually the guy that just wants to get a bunch of little properties, doesn't know how he's going to do it, and we provide them the vehicle to do that.
I
Jose,
think.
before we go into your example here, we had a question that goes into something I mentioned, though, and this kind of goes into the other reason why we do it. So let me pop up this question that's in the chat. I don't know if you can see it, but let me pop it up for everybody. Probably gonna cover our faces. Oh no, poops us up. Perfect.
That one, yeah, I was looking at that one.
Yeah. So can you explain? So sometimes we don't have a choice. So that's what I was gonna say. What happens when you don't have a choice, Jose? What happens when you get an email? Here's my contract, and there's 5 properties. And then can you explain what her question and how that happened? That was gonna be my question, but she led right into it.
Well, I mean, at that point, I would tell you, there's multiple options for the portfolio loan. And I've had them on multiple contracts. You don't want it that way, but if it's one seller and it's going to be, remember, these all got to close simultaneously, So if it's one seller, you can do it. But obviously, you're not going to be able to have multiple properties from different sellers on the same contract. So, we would prefer that they be individual contracts. But I guess for expediency, the one deal that I recently did, they gave me 3 different contracts for, like, one was 4 properties or like 3 properties, another one was 2 properties, and another one's 2 properties because they were written on different days. He found that one batch on one day, the other batch another, and they were all owned by the same person though, right? So that was odd.
That's interesting.
Right, 3 different contracts, 7 properties, same seller, but I guess they went out on different days and convinced themselves what they wanted, and that's how they did it. And with these types of loans, just even setting it up in Encompass is different. You could have 20 properties on one application. Where do you put them? Yeah, you just put them on the street address, and in the end, it's gonna boil down really to the internal setup when we set it up in the portal, the appraisals, and the title work, because it's gonna govern the loan here.
So, but I think she's going on when I said realtors do not put, if you're trying to give your client options, don't put 2 properties on the same contract, even if there's an empty lot. Can you just explain when we get a contract with 5 properties in one contract, we only have one option, right? Or 5,
Yeah.
even just 5 properties.
Oh yeah.
And that's it. So can you
Absolutely.
just
Yeah.
talk about, like, 5 on one, there's only one solution. 5 separate, we can do
Correct.
anything, right? We could have 5 different loans. We could have 5 of the same loans, but they're flexible. They can close at different times. But I really wanted to caution the realtors watching, because there's probably some realtors watching out there that, if you're got investors, that's great, but just be careful. Like you mentioned, your guy obviously had the solution before he went out there. But I hate when I get a contract with 5 properties. They're like, oh, do 5 different loans. I don't want a portfolio. It's like, well, I can't, right? So can you talk
Absolutely.
about
Yeah.
that
I've
comes
had a
across your
couple.
desk and your realtor hat? Yeah.
Had one of those recently, and yes, when possible, we want the flexibility of having the individual contracts so that we can provide options, because the portfolio option, like we're mentioning, isn't always the best option financially. If they have an option to have different contracts, then you should do so. Now, if it's a requirement of the seller that says, I'm only going to execute this deal on one contract because I want it's all or nothing, so then that's a different story. They're going to tell you either you close all of them, but I'm not going to let you close some of them and not close all of them. That's part of the deal. So yeah,
So
don't limit yourselves on that.
yeah, so that's where we're at here, right? So this example is if someone wants to do a portfolio or if someone has to do a portfolio. So those are kind of the 2 cases where we go with it, right? So let me pull this down. And you got your example ready, Jose?
Yeah. Now, the other thing I wanted to make a mention of is when you're getting out of the portfolio loan, that could present challenges too, especially when you don't have that carve out feature, because then what happens is, and we just ran into this in a deal that we placed now, that the person was getting out of a portfolio, 5 properties, and the loan servicer slash lien holder didn't want to give partial releases and payoffs on each property. So that is a challenge too. Then when you're figuring out the exit strategy there, then you have to find an outlet that will let you do it that way, and allocating a payoff to each property without having an actual individual payoff for each property. They just gotta get the 5, and once they get the appraisals, they allocate a percentage to each property and do it that way. But that can be a challenge.
For sure. All right, you ready for your example?
Yes, sir. All right. So the first example I have here is 25% down. And now I did a odd scenario. I have a 2 property portfolio here, 2 expensive properties. But look at that loan amount, right? 2,962,500. And through this particular option, they didn't limit me due to the loan amount, because that could be an option here. I mean, I went to my portal, got my pricing there. So this two property portfolio, 25% down payment, and my rate is pretty good there. And actually, it doesn't show my rate here. It should be more towards the bottom. Oh no.
Forgot to save the rate there. What was
No,
the rate?
yeah. Well, the rate on this one is 9.99 on this particular, and that's at par, 2.75 charge or whatever, is the charge there, but that's at full comp, no additional charge, no additional loan discount. 9.99 will get you 75% on that one. 5-year prepay declining. Now the same loan. Now see this one, I saved the rate.
There
So
you go.
now you can see what it looks like if it's saved. The same loan at a 30% down payment. So not a big drop in the rate from 9.99 to 9.865 is really minimal. So I think most of our investors would go the 75% route to get, save, a good amount of money, almost 200 grand in additional down payment that they're going to save. Now, this particular portfolio option does not allow carve outs. So this one, whatever you have, they're married to each other until payoff does them, until they depart each other through a payoff. That's it. Mutual payoff. That's all that's going to happen here. So we got 75 and 70% purchase options on this.
So
Yeah.
They do. Oh, and one other thing, they use large dollar amounts, but they also do low dollar amounts here. They will do in this option a 2 property portfolio for whoever would want to do that, and they'll go down pretty low in the values, probably like $75,000 each property in value, and do it at like around a $50,000 minimum loan allocation per property.
Correct. I believe that's it.
So, Jose, I wanted to have you touch on something, and then we do have some questions that we can bring up. But I did want to have you touch on something because it's so interesting. Because this a lot of loan officers would have spoken to the client that you were talking about as an example, and say that the minimum loan amount is X, and then the person, boom, done, right? Okay, can't do it, whatever. But you took this person, and by evaluating the situation, were able to not only get a deal done, but empower a borrower to go out there and get deals done and become a more powerful investor. So, a few parts to that. One of the parts that you talked about really is very interesting, of the fact that you said they got all these great deals because those properties were in the zone where a lot of people didn't have the 90,000 or 100,000 to buy them cash, but then a lot of people couldn't get them financed. I know firsthand a property that can't be financed is hard to sell, right? We had one that we sold not that long ago, and it's going to bring down the price. If people can't finance these properties, it's going to bring the price down. So Jose not only turned a non-deal into a deal, but now has an empowered borrower and investor that went out there and got multiple properties, got deals for the real estate agent. Now the real estate agent is happy, the client is happy, Jose is happy because he did a loan, but he also now has this borrower that knows he has the power to go out there and get a bunch of these other deals and repeat the process again. So that was just an interesting point. You want to touch on that, Jose?
Yeah, man. And I was just doing some quick math here, right? So he called me on asking about, 75, $80,000 properties, right? Most people would have like cringed, maybe. I don't know. They're thinking, it's limited options, and you're thinking compliance, all these kind of things that come into play when it's a low dollar amount loan. But this is where, when you put on your consultant hat, right? This is why we take it one step further at the mortgage calculator, and this is why we ask our MLOs to be hands on and know what's going on, so that when you're speaking with somebody about something like this, you can start making these connections in your brain, and offering your borrower some outside the box comments that make sense. I'm sure everybody else he spoke to before me did exactly what you just mentioned. They were like, we can do $75,000 loan amount, which would put you at a $94,000 purchase price, and it's one loan, and yada 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 yada, right? And he probably talked to a few people until, and he's thinking, that's not going to work for what I want, because they're even cheaper than that. He wanted to get them, cheaper than. And I made the connection, and what somebody else would have viewed as $75,000 minimum loan amount, I turned into, I think it was like a $512,000 loan or something like that. I mean, obviously it was work, because it's like 7 loans at one time, 7 appraisals, title orders, monitoring different variables. And you got to do that spreadsheet where you got to calculate the individual DSCRs and the individual loan allocated amount. And you got to pay attention to the spreadsheet, or else, you could lose it. But it worked out, and got a deal out of it, and true. Anybody else, 9 times out of 10, people would have just let him walk away thinking he can do anything.
So that's depending on the comp plan that individuals are at, but for most people, that's a $8,000 to $10,000 commission right there that could have just walked if you had just been like most other people. And like you said, it probably walked away from quite a few people before they got to you. That same deal slipped through a bunch of people's hands. Next thing I wanted to talk about, you touched on it a little bit, and you just touched on it now, but a little bit ago, you just kind of briefly went through it and didn't get through the point of, is it cheaper to do this? You said most investors think it's cheaper.
Yeah.
You just talked about separate appraisals, separate title.
Well,
is that true?
Again, it all depends how you quantify the cost, right? You got the real cost, then you have the opportunity cost, right?
Yes.
So if you're quantifying it up for now, I mean, I'll tell you, it probably is not going to be cheaper. The only thing maybe you're going to save on is you're going to save maybe a little bit on the title company closing fees, but then the investors add up like property review fees when they're having to look at 20 properties or something like that. They have 1 to 5, it's one cost; 6 to 10, it's another cost; 11 to 15, and so they have a little progressively increasing chart. So yes, in the end, they may save in the end maybe $200-300 going the portfolio route versus individually financing the properties. But what is the opportunity cost depending on what their exit strategy is? That's where we come into the picture and fill in those details and really differentiate ourselves from everybody else who couldn't make that connection and continue to add value to themselves in the transaction.
Yeah. Just to add to that too, just for that example there, if they're only going to save $200 or $300 and the property can do it, stands by itself, you have a contract that can do a DSCR loan on its own. You're looking at, Jose just presented 10% rates. We can get a DSCR in the sevens right now for the same cost, right? So you would be doing your customer a major disservice if the only reason that you're doing a portfolio loan is because someone suggested it, right? Or someone thinks they're going to save $200 or $300, when in reality they're going to save tens of thousands, maybe hundreds of thousands, maybe millions of dollars on a high amount loan, switching from a 10% interest rate to a 8% interest rate over a 30-year term. That's potentially millions of dollars, right? So big difference between $400 in closing fees and millions of dollars in additional costs in the end of 30 years, right? So got to pay attention into why we would do it. But if you have to do it, you have to do it, right? So that's why we only want to do it if we have to do it, because it's a misconception there of the dollar amount you're going to save is nothing compared to the giant cost.
Yep. Especially if they can't sell that property 2-3 years down the road. All of a sudden, some big developer comes and says, "I need your little piece there to complete my project." They're gonna give them the deal of a lifetime, and now they're stuck. So it can happen.
Yeah.
All right, you want to do
All
some
right. Well,
questions then, Kyle?
yeah, it looks like let's get into some questions here, Nick. You can pop them up on the screen there.
Someone asking what lender you're on the team. You got to check the lender list there, David. We're public, so we can't be saying everything there. Here we go. Good one from Ben. Do they have to be in the same state and the same area? That's a very good question, Jose.
That's one that's specific, and you'd have to reach out to whoever you're considering it. Typically, I've had them be in the same state. I don't know if that may necessarily be a requirement, but different states may have different laws for lending and stuff like that. What might be applicable for one title policy may not be applicable for another. And you got to remember, all of these, it's one blanket loan and one title policy. So I'm thinking that title policies are per state. So I'm thinking, due to title reasons, you probably are going to have them in the same state.
So we would just break it up into tranches of 3 or more per state typically. And Jose did the 2 example. Not many of our investors or outlets allow us to do 2 properties. Typically 3 or more is going to be a portfolio, blanket, cross collateral, whatever you want to call it. Here's a good one. Is it possible to assume a portfolio loan, Jose?
Oh, I'd have to again look at the guidelines. They're all different. I don't know.
I don't think I've ever seen any loan that we've ever done that's assumable, really, besides FHA and VA, which are by law assumable, right? So I think
they're DSCR loans. Typically, all these portfolio loans are DSCR loans, and I don't think DSCR loans are assumable.
Yep. Right.
I think that looks like it's it here. Any other questions?
If you guys have any questions, throw them in the chat before we go.
But overall, I think it's a great tool, right? So now we're a little more familiar with how to use it as a tool, when you would use it. And really, in reality, especially with our team, it's more so when not to use it, right? It's more so taking people out of portfolio loans, or just, as Jose said, getting to the bottom of why your client may think they want a portfolio loan, and making sure to educate them and consult them through it. Because 9 times out of 10, that's not what would be best. They just need to be educated on that.
Portfolio loans are a great way to get all these multi-pack loans that we're doing, because all of these investors that have these portfolio loans, we're doing a great job of finding them. I think we're probably doing the best job of probably any company out there finding these people that own all of these multiple property portfolios, and then we are refinancing them out of all of this portfolios or hard money portfolios that they're in that are really bad and restrictive, and I'm disclosing multi-packs for MLOs all the time who took the time to analyze the situation and was able to convey the message clearly and get them out of the portfolio into 5, 6, 7, 8, 9 pack or more.
Yeah, I mean, imagine that swing of going from either hard money or just any type of, portfolio loan to then going into a fixed rate 30-year DSCR loan at a few percentage cheaper interest rate, and with no restrictions, not attached to anything. I mean, what a huge swing of taking them from something or steering them away from something that has all those restrictions, those high rates, and all that into a nice, cheap 30-year fixed, safe, not going to have a balloon type option, can sell at any time, refi at any time. I mean, it's a big difference. And that's why we need to be good consultants and make sure that we're putting our clients in those good situations.
We have one other question pop up here about negotiating the deal. The carve out policy has nothing to do with the real estate end of the deal. This just has to do with the loan program. The loan features either has a carve off policy in the loan program or it does not. And we have both. So, and it just depends, right? Who's gonna, which at the end, which bank or whichever insurance agency, whichever end investor, what they want to do, right? Because at the end of the day, it's the end investor that kind of has a say there, and some of them want it, and some of them don't.
Yeah, for sure, it will be existent, and it's something that you should take into consideration. Definitely, you just have to be proactive and inquire, and so you can properly advise your borrower what it is. It
And
shouldn't catch anybody by surprise because it exists. The carve out policies of everybody they're already in place. So you just have to know what it is so you can inquire and then properly consult your borrower, and then they make the decision on which way they want to take it.
could be an add-on too, so make sure you definitely ask. It could be a part of the program where they just need to pay a little bit more, and in that case you definitely want to advise your client to take advantage of that add-on feature. Yes, we want this, so you have an exit strategy if we're going to go into this, right? So just make sure you plan it all up front.
All right. Well, I don't see any more questions, so we can go ahead and wrap it up then. So we do this every Tuesday night at 7 p.m. Eastern here on the YouTube channel. We also have a show at 11 a.m. Eastern time every weekday where we go over the different rates and do a deep dive into a subject. And we'll be back here tomorrow on Wednesdays at 7 p.m. Eastern for our loan officer sales training. So thank you everybody for tuning in. Thank you everybody for the questions in the chat. We appreciate it. And we will see you tomorrow, 7 p.m. Eastern time, right here on the YouTube channel.